all have money questions, but most of us keep them in because we don't have a reliable place to ask them. This is 5Q IQ Financial Power-Ups with Trajan Wealth, where each week 3 financial experts sit down with 5 questions straight from listeners like you. We'll talk through everyday decisions, long-term planning, and the trends you're hearing about in the news, always with an eye toward what's practical for your day-to-day life. I'm Jeff Jr., founder and CEO of Trajan Wealth. With me are financial advisors Corbett and Marti Bryant. We've got decades of experience working together. So if you're looking for clear explanations, thoughtful perspectives, and a judgment-free space to learn, you're in the right spot. So let's jump in. Here is question number 1. So how would you prepare for a market bubble, like an alleged AI bubble that we keep hearing about?
Well, I mean, prepare can mean different things, but certainly diversification is going to be your best form of defense for any type of bubble that's out there. You know, the internet bubble that we had back in late 90s, early 2000s, the oil bubble that we had in like 2012, 2013. So having a properly diversified portfolio is certainly going to help. It's not going to be perfect because the market will still continue to go up and down. But if you can minimize the downside movement, then you have less to have to try and make up on the backside. So because if you lose half, you don't have to make up 50% to get back to even. You have to double your money just to get back to break even.
Which means 100%.
Right.
Yeah. And if you're specific, if we're talking specifically AI, since that's what everybody's talking about now, NVIDIA, for one, look at how much you have. So I know Corbett just said diversify, but I've been seeing more and more retail investors or people that are seeking out some professional money management that have, kind of DIYers. They're managing their own assets, and they're very, very heavy in NVIDIA, Meta.
Yeah, I mean, if they've held it for 2 or 3 years,
Yeah.
and they've not cut back, that percentage of the portfolio has just grown so high that it's just now overweight, and you're taking on what's called undue risk.
Right. But what I'm getting at, thank you for interrupting me there.
Absolutely, my pleasure.
What I'm trying to get at here is make sure to, if you're not already doing it, look at their fundamentals. Okay, so look at their earnings reports or understand what an earnings report is. How are they spending their money? How much are they spending what we call CapEx? So I'm sure some of these people watch, CNBC and those shows. What are their capital expenditures? Does it seem that
AKA CapEx.
CapEx, right? Does it seem like that's sustainable for that company? What are their revenues? So you need to really understand how to look at the fundamentals of these companies and figure out maybe on your own, is it worth it to continue to hold this much? There's going to probably be a pullback, but are they going to have that ability to continue to scale it the way they were?
Right. And certainly, because you can still continue to look at their earnings reports, and if everything sounds fantastic and they're going to continue to grow at the same pace, still, it's that ability to, yep, I should probably take some risk off the table, because the reality is it's never a profit until you take it. So the ability to take, what risk parameters am I willing to accept for my portfolio to be so overweight in one stock or one sector?
Right.
So having Trajan Wealth's view of being tactical, that's how we can really assist in minimizing the pain that you could have inflicted from an AI bubble.
Yeah.
I mean, I'd also say, let's be honest. I mean, who's going to look at their earnings statements and get on their quarterly conference calls and review
Called Edgar
CapEx?
reports.
And it
No
just
one.
doesn't happen, right?
Yeah, it's
Very
not
few.
going to happen.
People are investing because there's hype around it,
Right.
and that's the unfortunate thing. And that's really what causes the bubbles.
Yeah. Well, yeah, with some of the companies, there's a lot of hype around them. And I'm just going to pick on Tesla. There's a lot of hype around Tesla. Are they going to perform the way people are assuming they're going to be able to perform?
Right. But the hype around Tesla is, the things that are within the
Well,
system.
they're innovators. They have a lot of ability to innovate,
Right.
but how much of that innovation is going to come to fruition in the next year, 2 years, 3 years? Again, this is going to come back to, is this going to be a long-term investment, or are you looking for that short-term kill
Right. Or a trade.
or trade?
There's a $1 trillion bet on it.
Yeah,
Yep.
there certainly is. There certainly is.
So let's talk about the next question. Question number 2. Why do the economy and the stock market look so different?
Well, they measure different things. So the stock market is forward-looking. The economy is what's happened. So that's why there's a little bit of a divergence there.
Right.
Okay,
economy more real time,
that's correct.
market looking forward,
Mm-hmm.
where we are at today with the economy, knowing that they're cutting rates into the future, knowing that that will make easier for people to borrow money, hopefully mortgage rates and all those different things, but also by cutting rates may not impact mortgage rates right now, but for things that are tied to prime, HELOCs, credit cards, things like that, that interest carry is going to come down. So that should hopefully have the economy catch up to where the market is at.
But it never really does, because let's look at an index. So S&P 500, that's measuring 503 of our large cap stocks, whereas that's not accounting for all of the other companies that we have. Small mid cap companies, there are
Underperformed.
thousands and tens of thousands of companies that aren't even being represented in the indexes that have the small and mid cap companies.
True. I mean, same
So
thing
there's
with the Dow.
there's no way that the stock market will ever look like the economy, because it's not a true measure of what our economy is.
They could be pretty close, but nonetheless, that's because the future forecast is the same as it is currently.
Right.
But
And then we've got, our economy is GDP, domestic focus, and stock market can be globally focused.
Typically with international earnings,
Mm-hmm.
which
Right.
then have to get impacted by the dollar, because now we are coming into a interest rate cutting phase. The dollar is probably only going to continue to fade. For example, if you had had silver for the last 2 years or gold, all those two metals have done very well, but only recently have you seen silver really outpace the performance of what gold has had. Silver, more of an industrial metal, could be said, oh, that is a sign that the economy is getting stronger to a point. I would say it's more of a technical aspect because it has broken out above all previous highs, excluding the all-time high that they had with the Hunt brothers in 1982.
Well, let's bring it back from 1982 to, what we're kind of talking about here. So maybe we can even look at the difference in the sectors of the stock market versus
completely.
the sectors of our economy.
Yeah, I mean, technology compared to a utility, those two are never going to grow the same.
Right.
Unless it's APS, and then very possible as we're getting ready for our 14% increase in
Yeah, that's
cost
specific
there.
to Arizona. But
Right.
Yeah.
But still, the ability to say, what does that really look like? A utility company is never going to grow 30%.
Right.
It's just not possible. It's not how they're built. Knowing compared to something like a company like, say, NVIDIA or Alphabet or Microsoft, those two companies are probably good examples. Both have been around for at least 25 years. Both are still continuing to grow very well because they've adapted,
Exactly.
especially when you look at Alphabet and all the different things that they do. Waymo.
Where they have their fingers in the
Right.
pulse of.
But also, they are now making GPUs, the same chips that NVIDIA makes for artificial intelligence, but not
it's
as
only
fast, but
specific
cheaper.
to, and it's also specific to what they're developing.
Right. But the same
Yeah.
thing, artificial intelligence chips dominated by NVIDIA, but now you're starting to see Alphabet come in and say, okay, hey, do you need the latest and greatest chip to make AI work? No. Okay. If you have
Right.
this chip that maybe, say, runs 25% slower, but is half the cost, if it fits the bill for what you need, then
So you don't
fantastic.
need the latest iPhone. You can still use the,
Right.
or a Droid. You pick up a Droid and it's always going to work because of, it's got the software that's tied to it. Microsoft's not going any. You could turn on an old Droid and it's going to still work.
But I think, going back to the original question,
Oh.
I think you summed it up perfectly, which is it's not uncommon for the market and the economy to be similar or completely opposite. Because the market, like you said, Marty, is forward-looking. It's reacting to what they think is going to happen in the future, and the economy is what's going on right now.
Well,
Well, and the market has the concentration of wealth sitting inside of it.
Right.
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 Well, the thing
So
is,
it's a little different perspective. But that being said, let's move on to question number 3.
Okay.
So question number 3 is about Social Security. So will Social Security run out and when? And is there anything that can be done to avoid that?
well, it's not going to run out.
Yeah.
2035.
Just because of taxing power.
Right.
It's
taxing power. But, as it stands today, if there are no changes made, then it will go to 77% of what the current payment benefit is. So if they don't do anything, either raise taxes or something to offset that, my thought process is that I missed being able to drink by 6 months at 18. So 1970 being that cutoff is if you were born after 1970, we're going to push the retirement age from 62 to 65. We're going to push the max age up from 70 to 72. Now, I know that's been floated in Congress a couple different times, but no one can seem to really get around that. Is it a tax increase? No. Is it a reduction in benefits? No. But why people don't seem to understand that could be beneficial is a little baffling to me. But to your point, it's never going to truly run out because of the taxing power on what you pay and what your employer pays.
So Social Security was underfunded in 1984, I think is the first time it was underfunded. Prior to 1984, it wasn't taxable, right? It was a benefit that we received kind of like a pension for paying into it. Now, so in 84, when they redid the calculations, it became taxable, 50% up to 85%, depending on what your income is. So when you are doing your taxes to figure out how much Social Security is taxable, all sources of income are in that equation. And that includes your, muni bonds, your government tax-free, income. All of that goes into the income to decide how much of your Social Security benefit is taxable. So, and then 50% of your Social Security benefit also goes into it.
Right.
So
you're saying municipal bonds?
Yes, all income except Roth money. Roth money is the only money that's not
But
included.
municipal bonds are tax-free.
All money, with the exception of Roth income, goes into the calculation to determine how much is taxable of your Social Security benefit.
Okay.
Right. You think it's tax-free. Maybe it's not federally taxed, but it goes into the calculation to see how much of your Social Security benefit is taxable. So there's super secret things going on behind unless you learn what that spider web looks like, right? Now, they haven't adjusted any of those figures for inflation or, cost of living. So it's still set at 1984 standards, right? So behind the scenes, it has been changing. We've been taxing more, so we know income levels.
Right.
Every year we see the income. You will always pay into Medicare, but how much you pay into Social Security, there's a cap. And every year they keep increasing that cap. So more people are paying more into the system for a longer period of time. Now we're living longer. We talked about RMDs, and I think I convoluted the RMD with Social Security a little bit in our last conversation. But people are working longer. They're paying into the system longer. Our full retirement age for Social Security benefit is now 67. Medicare is 65. Earliest you can take Social Security at 62.
Right.
Now if you take it at 62, they're going to get a 40% permanent reduction in the benefit.
If they're still working.
No, it's a 40, whether you're working or not, it's 8% per year reduction in that benefit for every year you take it early.
Right.
Right. But then you're right. If they continue to work thinking, oh my gosh, this is going to be a little bump in income that I need to get me through.
It's like a double whammy.
You're wrong, because now you're going to have earnings restrictions. $1 for every $2 you earn over that current year's limitation, it's gone until you hit full retirement age.
Which has been increased.
Right? To 67, you don't get a lump sum payout. They just recalibrate that full retirement age benefit that was already reduced by 40%, and they add that money back in. So there's no way of getting around, trying to work the system. They got rid of all the cool ways that you could, like file and suspend with restricted spousal benefit. All that's gone. Right. So now the only way that you can file is you file, and you take your Social Security benefit. You have a spouse. Let's say that the spouse doesn't have at least half of what the primary earnings benefit is. So one spouse's benefit's $3,200, the other one is $1,200.
Right.
Okay, the one at $1,200, they're going to get bumped up to half of that 32. However, you have to wait until that other spouse takes their benefit.
Right.
If they're trying to delay to 70 to get the delayed credits, you're not going to get your bump up to half of their full retirement age benefit.
Right.
So it's still a spider web. It is a tax, and as long as people are working, it's going to be there.
But nonetheless, it's not going away
Not
anytime
going away.
soon.
No.
There's too many levers that they have the
There are.
ability to pull. But I'll change topics a little bit. What do you guys feel about privatizing Social Security?
It'd be fantastic.
I'm all
Give
for
me
it.
more
All
control.
for it here too.
Yeah, because the best Social Security is ever going to be able to do from a increase standpoint is treasuries. And let's be honest, 10-year treasuries at 4%, where inflation's at 3%, you've got a real return of 1%. No, Now, granted, there could be restrictions because I think the last time that this was really seriously discussed was with George W. Bush. So the ability to know that you have control of what I put in and what my employer put in, and compared to just leaving it into the hands of the government.
So set it up similar to TSP.
Right.
So where you have
Not
different
crazy things like
right,
you do,
right.
ETFs or stocks.
Can't
but
do
yes,
options and all
Right.
this
the
stuff.
G
that have,
fund, I fund,
Right,
all those
that's
different
right.
things
S
to give at least some type
right,
of control.
right.
So
I remember my dad was waiting until 65. So at his age, it was full retirement age at 65. He was 64. He kept on working to get to 65. He died at 64. The death benefit that was paid out was $250.
Yeah. Now
That's,
it's 50.
That's the check that I received. Ridiculous.
$50.
He paid into it his entire life. So that's why I'm all for it. I mean, that's part of the reason I'm all for privatizing it, because it really is just an additional tax and it's our own money. It's not like it's free money from the government.
And take control of your assets. Take
Right.
control of your money. And I wish we could do that there.
And if you do have more time to save for yourself, don't be so set on Social Security.
I want to throw one more thing out there, and then you can wrap up. If you take your Social Security benefit at 62 and you don't die before you are 78 and 11 months, you have lost. You've lost.
Because you didn't
out.
leave it
That's your
compounded.
break even.
Yeah.
You've got to die. Yeah.
Great.
unless you turn it on, you don't need that money, and invest it. That's the part
Not
that
if
I
you're
would love
still
to
working. Absolutely
Otherwise, you're taxed at 50%.
Right.
not.
And that's why I tell most people, look, don't wait till 70. Tomorrow's not guaranteed.
I
Turn it on
don't.
at 67. Because if you turn on 67, there's no penalty any longer. So no longer, if you don't need it and the ability to invest, let's say you're getting $3,500 a month.
Only if you can get guaranteed 8% plus cost of living adjustments.
Yeah, but still, it's if you
Keep
die
arguing.
at age
Keep ar- it
67,
doesn't matter.
or 68,
Doesn't matter.
it's a use it or lose it proposition.
Oh, so that 30 grand would have made a difference in your life?
The unfortunate thing
Disagree.
with this debate is we just won't know the truth until you actually do it. And it's going to really depend on what your investments do at
mean,
that
I know
time,
the
right?
This is what
Marty's-
go to your doctor and find out when you're going to die, and that'll take care of all of it.
So we're on to question number 4. And this is, how do I prioritize paying off my debt versus saving for retirement?
All right. So there are some good types of debt out there. So not to disparage anyone, there are some amazing coaches out there, but
You mean ones that have like a Tennessee draw?
kind of. Yes. When I have clients come into my office, they're late 50s, looking to retire within the next 10 years or so, and they're so excited. I am debt free. I am out of debt. My house is paid off, everything. I say, that is phenomenal. I'm very excited for you. You've done a great job. What have you saved for retirement? Well, I did the company match. So they have nothing. They're 10 years out, maybe. They have nothing saved for retirement. And so then I ask them, so we're going to use your house when you're old enough, throw a reverse mortgage on there, take some cash out. What are you planning on doing for retirement?
Airbnb.
Yeah. Get roommates. So when we start talking about debt, let's be realistic about it. Okay. A house is good debt. Get rid of your high interest credit cards.
For sure.
Right. So you can start out, there's 2 different methods. You can do the snowball, start with the lowest amount first, and then pay off the highest without changing how much you're paying out each month. So if you're paying out $1,000 a month towards credit card debt, leave it at $1,000, but allocate the largest amount to the smallest debt, or the avalanche. Start with the largest, go to the
Build
smallest.
confidence. Feel
Right.
like you're accomplishing something compared
Right.
to like, okay, I'm just chipping away, but I'm not feeling like
Right.
I'm getting anywhere.
Or if you have good credit, if you have good credit and you can consolidate all that debt into a 17% rate of return or a 17% interest rate or 18%, I guarantee you some of those credit cards are sitting at 30%.
Oh, totally.
So it's still not sexy, but consolidate the debt and invest in yourself at that point. Stop overspending.
Well,
Yeah, and don't think that all debt is bad debt.
Right.
I mean,
Right.
especially the house. Don't be so eager to pay off the house. I mean, I understand it feels like this weight on your shoulders when you don't have your house paid off, but it's actually a good thing.
Yeah.
If you are disciplined enough to reallocate the extra money you would have put into your house into an investment.
right.
You do the math on the difference between investing that money or paying off your house. It's a huge difference, especially if you have a little bit of time. And if you pay off your house, you lose the tax benefit that goes along with it. And what if you need money when you're retired? You're not going to be able to go to the bank and refinance it because you have no way to pay it back unless, of course, you do a reverse mortgage or something,
Which is a
something
whole
like
other
that,
scenario.
which is a whole different scenario.
But even after if you do pay off the house, you still have property taxes. You still have homeowners insurance. So like, yay, my house is paid off. But guess what? When you factor in, the property taxes and homeowners insurance, it's probably going to be anywhere from say $300 to $600 a month still. And having the ability to just have that built into your mortgage cost, yes. So, having the ability to say, hey, especially if your mortgage rate's under 5%. I mean, we all have clients that come and say, oh, I want to pay off my house because I've got this cash. And I'm like, no, you pay off the mortgage. Now you've taken away that liquidity. And basically what you're telling yourself is, I can't beat 2.8%. And that's what you're telling me as your fiduciary advisor. Corbett, you can't beat 2.8%, so I'm going to pay off my mortgage. If I can't beat 2.8%, then yeah, the reality is I should probably be fired.
Well, the other thing to take into account is by the time you get to the point of thinking you can afford to pay off your house, you're done with the interest anyway, because they're front end loaded, or you might be down to minimal interest and you're only paying off principal. So now you're just investing your cash into an illiquid investment at that point in time. Leave the cash to work for you. Make the little bit of a payment. Same thing with cars. You want to go buy a car, don't smoke all your cash because I don't want to carry debt. Well, if there's 0% interest rates on vehicle loans, and you can take it, we're going to grow the money.
And there is and there has been for up to 7 years.
Right, exactly.
That's free money.
It is free money. So
giving you free
other
money.
free money. So now the money that you're talking about using to pay off all your debt, if you're not smart about it and you're only doing the minimum into your 401k for the match, you're losing out. We were just talking about 30 years of compounded growth.
Right. That's the part that gets forgotten. Say, yay, you take your 401k contributions away. I'm going to pay down debt. Okay, that's nice in the near term. What I'd rather have happen is, I'd rather see you pay a little bit more in interest now compared to keeping your 401k or maybe even increasing a little bit, because especially if you're, say, like 28 years old. Yes, you've got $10,000 in credit card debt. I get that. But the ability to say, hey, you know what? Maybe have a budget and live below your means, because that's how you truly build wealth. But having the ability to say, yep, I'm going to put 5% into my 401k. Minimum scenario is 3% match, but that compounding effect of, say, 35, 40 years is huge compared to, yep, I paid an extra $500 in interest. Okay, that $500 is going to be a rounding error by letting it grow for 30, 35, 40 years.
And if you work so hard in the early stages to pay off your debt, you'd much rather save $200 a month or $100 a month when you're young, as opposed to $1,000, $1,500 a month
to play catch up.
And that's the problem with paying off your debt. So I think just keep in mind, not all debt is the same. Is the biggest message. There is good debt.
100%. And stop instant gratification. That is, this society is, everything is disposable. My phone is broken. I want a new one. Everything is disposable. Right? Laptops, it's out of date and it's not meant to last more than a couple years anyway. Get another one. So invest in yourself first. Most millionaires make less than 6 figures per year because they have made the sacrifices in their early years and throughout their life, and they've invested in themselves, lived within their means, invested in their 401k plans.
Great question. Thank you for that. Let's move on to question number 5. So I've been working with a broker for a while. What can a fiduciary do for me that a broker can't? Great question. We could get pretty deep here.
Yeah, we can.
Since you started the idea of fiduciary, let's have you start it off.
Yeah, sure. I when I started in the industry, as so many people have that started in the financial services business, most of us started as brokers. And oftentimes the reason you start as a broker is because you can't earn enough money as a fiduciary to support any kind of lifestyle. So you have to start and you have to sell investments for commissions. It was back in 2012 that I started Trajan Wealth, and I wanted to be a fee only. We had the ability to do it, and fee only or fiduciary means we have an obligation to our clients and we have to do what's right by our clients. Whereas a broker, on the other hand, has what's called a suitability standard. So anytime a broker makes a recommendation, all they have to do is make the recommendation that is suitable. It's a much looser standard than the fiduciary standard.
Right.
Yeah, so the big difference between a broker and, let's say, fee only or a fiduciary is a fiduciary charges one flat percentage per year. It's very transparent. You know exactly what it is. Let's just use 1.25%. So that is the total fee that you're paying per year. Unlike a broker who's going to invest you into, again, let's say a mutual fund that pays a commission, they're going to get an upfront sales charge. That's what pays their commission. But also internally in that mutual fund, it can be 1.25%, 2%. I think the highest fee that the regulatory bodies allow them to charge is 3% per year, if I'm not mistaken. So I have seen some that get fairly expensive. I don't think I've ever seen one that charges the full 3%, but I've seen some that get to 2.5%.
Right.
That's every year.
Yep. Well, then and you've got 12B1 fees on top of that, especially for Class C shares. So if you have that Class C share in your statements, run from
So a
there.
12B1, that advertising costs.
Right.
So when you see those beautiful commercials, you're the one paying for those.
Right. I mean, everybody has to make money. Don't get me wrong.
Right.
Trajan Wealth has to make money. The mutual funds have to make money. But I think there's a way to do it in a very transparent manner.
Yes.
And I think the mutual fund companies and the brokers have got away with it for way too long because people just do not know what they're buying.
Well, we haven't had enough uprising from the citizens. Capitol Hill's not going to listen to us. We don't have the deep pockets. Fidelity has the deep pockets.
Totally.
Schwab.
But also, because of the advent of ETFs, you've seen the dramatic slowdown of issuance of new mutual funds.
Yeah.
Compared to the rapid increase of ETFs.
Well,
People are getting smarter about it.
And Warren Buffett called ETFs the mutual fund of the future.
Right.
As they are.
And I'd like to start seeing them in our employer-sponsored plans.
Yeah. But I think there has been a lot of outcry from the investing public.
But
You know,
there just hasn't been enough to push because
Yeah.
you've got all the lobbyists.
Regulation. Oh, absolutely.
Well, all the kickbacks that are
Absolutely.
involved,
Absolutely.
the deep pockets, we don't even know the half of it.
Right.
Yeah.
Yeah, a lot of fee compression going on, but nonetheless, it's still
Great work.
not to a point where it needs to be or where it's regulated to be fully transparent.
Right. Oh,
The transparency is read your prospectus. Come on.
Yeah.
Who in the world is going to read that darn prospectus?
Nobody.
So, great discussion, guys. That was wonderful. So before we wrap up, I just ask to take a moment to notice one idea from today's show that you can act on, regardless of how small it might be. Consistent action is what moves your financial life forward. But the most important action you can take is to simply start. So thanks for listening to 5QIQ Financial Power-Ups with Trajan Wealth. If you've learned anything today, please share it with someone who could benefit from it too. And of course, if a question has been nagging at you, don't sit on that. Send it to us at trajanwealth.com/5QIQ. All of these questions we're getting from you. So just know again, we're here to help you plan smarter and dream bigger. We'll talk to you again next week.